Hello and welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called the Keltner Breakout Trend Rider. This automated strategy is built around a classic volatility tool, the Keltner Channel, combined with a moving average slope filter to follow strong directional moves. Over the next several minutes, we'll break down exactly how it reads the market, how it enters and exits, and how it manages risk on every position. By the end, you'll understand the logic line by line. Remember, this is educational information only and not financial advice. Let's get started. So what exactly does the Keltner Breakout Trend Rider do? At its heart, this is a volatility channel trend following strategy. It builds a Keltner channel around price, which is simply a moving average center line with an upper and lower band placed a certain distance away. That center line is an exponential moving average, or EMA, and the distance to each band is measured using the average true range, or ATR, a standard gauge of how much a market is moving. When ATR expands, the channel widens. When the market quietens, the channel contracts. This lets the bands breathe with current conditions instead of staying fixed. The core idea is momentum. When price closes beyond one of these bands for the first time, it suggests a strong directional move is underway. But a break on its own can be misleading in a sideways market. So the strategy adds a second condition. The EMA itself must be sloping in the same direction as the break. This slope acts as a regime filter, helping the approach stay out of choppy, directionless conditions and only participate when there is genuine trend behind the move. This expert advisor is designed to be studied by traders who are interested in systematic, rules-based trend following and who want to understand how volatility and momentum can be combined in code. It runs symmetrically, so the long and short rules are mirror images of each other, and it isn't tied to any specific symbol, session, or time frame. It simply applies its logic to whatever chart it's attached to. Only a small handful of meaningful parameters drive it, which is a deliberate choice to reduce the risk of curve fitting to past data. As always, remember that trading carries real risk, and losses are a normal part of any strategy. Let's walk through the mechanics step by step. First, this is a bar close strategy. It doesn't react to every tick. Instead, it waits for each candle to fully close and then makes a single, considered decision. That reduces noise and keeps the behavior consistent. On each completed bar, the expert advisor calculates three things: the EMA center line, the ATR, and from those the upper and lower channel bands. The upper band sits at the EMA plus the channel multiplier times ATR, and the lower band sits the same distance below. By default, the channel multiplier is 1.5, the EMA period is 20, and the ATR period is 14. Now for the entry logic. For a long signal, two conditions must both be satisfied. The current bar must close above the upper band, and, importantly, the previous bar's close must have been inside the channel. That combination defines a fresh cross, the first close beyond the band rather than a market that's been hugging it for a while. On top of that, the EMA must be sloping upward, measured over the slope loopback window of 5 bars. Only when the fresh upside break and the rising EMA agree does the strategy signal a long entry. The short side is the exact mirror image, a fresh close below the lower band while the EMA slopes downward. Every position is protected from the moment it opens. The stop loss is placed at the stop multiplier times ATR away from entry, by default 2 ATRs, and the take profit sits at the take profit multiple, 3 ATRs, in the favorable direction. Because both are measured in ATR, the protective distances automatically adapt to volatility. As the trade develops, a chandelier-style trailing stop comes into play. It follows price at the trail multiple times ATR, but it only ever moves in the trade's favor. It ratchets closer to lock in progress and never loosens. Finally, if an opposite fresh break appears, the expert advisor closes the current position early, treating that as an exit warning. Only one position is ever held at a time, with no averaging and no grid, which helps keep risk contained. Let's look at the actual MQL5 code the expert advisor runs. At the top are the input parameters, and these mirror the design exactly. EMA period is 20 and ATR period is 14, defining the two indicators. Channel multiple, defaulting to 1.5, sets how far the bands sit from the center line. StopMult TpMult and TrailMult, which are 2, 3, and 2.5, control the stop, target, and trailing distances, all measured in ATRs. Slope loopback of 5 sets how far back we measure the EMA slope, and base lots, max lots, and magic handle sizing and trade identification. Next comes the signal block. The code builds the upper and lower bands from the EMA and ATR. Then it checks for a fresh cross. Cross up is true when the previous close was inside the channel and the current close is above the upper band, and cross down is the mirror for the downside. It also measures slope as the EMA now minus the EMA a few bars back. Now look at the two sides. A long signal requires a positive slope and a cross up. When that's satisfied, the stop is set below entry at StopMult times ATR, the target above entry at TpMult times ATR, and the expert advisor calls trade.buy. The short signal is fully symmetric, a negative slope and a cross down, with the stop placed above entry, the target below, and a call to trade.sell. Both sides use the same ATR-based distances, so the code stays clean, balanced, and easy to audit. Now let's bring it all together on the chart. What you're seeing is a candlestick sequence with the Keltner channel drawn right on top of price. The gold line running through the middle is the EMA basis, and the two blue lines above and below it are the upper and lower bands, each sitting 1.5 ATRs away from that center line. Watch how the bands widen and narrow as volatility changes. That's the ATR at work. Let's start on the left. The first few candles are drifting gently higher, and notice the EMA basis is beginning to tilt upward with them. Price is still contained inside the channel here, closing below the upper band, so the strategy simply waits. There's no fresh break yet, and patience is part of the design. Then we reach the standout candle. A strong bullish bar pushes up and closes clearly above the upper band for the first time. The previous candle had closed inside the channel, so this is a genuine fresh cross, not price that's been hugging the band. At the same moment, the EMA basis is sloping upward, confirming there's real trend behind the move. Both conditions now agree, and the buy entry marker appears. This is exactly the long setup we described, a fresh upside break confirmed by a rising center line. From there, the trade is managed automatically. The initial stop sits below entry at 2 ATRs, and the take-profit target is set 3 ATRs above, giving a reward-to-risk profile of 3-2, or 1.5-1. Watch what price does next. The following candles continue pushing higher, each one extending the move, until price reaches the take-profit target and the position closes in profit on this illustration. Notice too how the trailing stop would have been ratcheting upward underneath price the whole way, protecting the gains as they built. Now the character of the market changes. After that peak, the candles roll over and begin falling, and crucially the EMA basis flattens and then tips downward. The channel starts sliding lower with price. We're now setting up for the mirror image on the short side. Here comes the second key candle. A firm bearish bar drops down and closes below the lower band for the first time, while the previous candle had closed inside the channel. Again, that's a fresh cross rather than a market already sitting beyond the band. And with the EMA now sloping downward, the regime filter agrees. The sell entry marker appears, giving us a clean short setup that mirrors the long exactly. The management is identical but flipped. The stop sits above entry at 2 ATRs, and the take-profit target is placed 3 ATRs below. Follow the next candles down. Price continues lower, extending the move, until it reaches the take-profit target and the short position closes on this illustration. Once more, the trailing stop would have been stepping down above price, locking in the decline in the trade's favor. So in one clean sequence you've seen both halves of the strategy, a fresh break above the upper band with a rising EMA for the long, and a fresh break below the lower band with a falling EMA for the short. Same rules, same risk framework, just mirrored. And remember, this is a simplified illustration to show the logic. Real markets are far messier, breaks can fail, and losses are a normal part of trading any approach like this. And that brings us to the end of our breakdown of the Keltner Breakout Trend Rider. Today we covered how the strategy builds a Keltner channel from an EMA and ATR, how it looks for a fresh close beyond a band confirmed by the slope of the center line, and how it manages every trade with ATR-based stops, targets, and a ratcheting trailing stop. We also walked through both a long and a short example on the chart. Everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you'd like us to examine next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.